we will discuss on Test October 2019, question 2 on intangible asset. Part A of the question, an intangible asset can be recognized an asset if it meets the definition of IA, which is an identifiable non-monetary asset without physical substance. Briefly explain the criteria of identifiability according to MFRS 138 intangible asset. Okay, so under intangible asset, okay, it is recognized as an IA if it fulfills the recognition criteria as well as it fulfills the three characteristics as an IA. The three characteristics are identifiable, controllable, and provide future economic benefit. So this question asks specifically on identifiability. How do you say that the asset is identifiable? So there is two identifiability. Okay, there is two factors that indicate this asset. This IA is identifiable. One, it is separable. Okay, what does it mean by separable? Means that the IA, okay, is capable of being separated. Okay, capable of being separated from the entity and sold. Okay, you can sell it separately, or you can transfer the asset to another party. Okay, you can license the intangible asset, or you rent it out, or you exchange with other asset. Alright. Individually, whether it is individually or together with a related contract. Individually or with related contract. Okay, the second factor that indicate it is identifiable, okay, it should fulfill either one, whether it is separable or it can it arise from contractual or other legal rights. So if one of these conditions happen, then it is considered as identifiable. Therefore, it fulfills one of the three criteria I mentioned just now. Okay, that is the first part of the question. Part B, Labu Sayong operate a chain of traditional homestay in Negeri Sembilan. The company decided to promote aggressively its homestay chain to local and international tourism by emphasizing on exclusive and modern design wood of traditional Malay houses. On 1st January 16, it acquired a corporate customer list. Customer list is an intangible asset because these are the customer that purchase your product in which you can generate income. Alright, so asset is something that you own, it's a resources that enable you to generate income. So this was acquired on 1st January 16. Okay, so you acquire the customer list for 250,000, and it is estimated to be valid for 5 years. So this is the useful life or the economic life of the IA. Okay, 5 years. Due to the revision of new customer in the tourism industry, on 31st December 18, the fair value 31st December 18, the fair value of the customer list was 80,000. Okay, IA is measuring the revaluation model. So this is the revaluation, the measurement of the subsequent cost is similar to the PPE, right? PPE we either measure based on the cost model or revaluation model. So same goes to IA. We also use either cost model or revaluation model. So when it is a revaluation model, you have to compare the carrying value and fair value, and you need to find whether you get surplus or deficit. Okay, so in this case, you'll see that okay, the question, explain the accounting treatment, for the year ended 31st December 18. So if the question asks for 31st ended 31st December 18, that means you need to explain about the customer list from 1st January 18 until 31st December 18. So the answer, okay, before we start with the accounting treatment, let's calculate first. Since we know this is a fair value and using revaluation model, you have to compare the carrying value. So let's compute this one first. So carrying value is cost less accumulated amortization. Okay, for PPE, it is accumulated depreciation. For IA, it is accumulated amortization. It just the term used is different, but the way you calculate it will be similar. So cost here is 250,000 minus the accumulated amortization, that is the day you acquire the IA up to the revaluation date. So that will be the accumulated amortization. Okay, so that will be 250,000 divided by 5 years and times with how many years? From 16 to 18, it is 3 years. So you should get accumulated of 150,000. So this one will be deducted here. So you will get the carrying value of RM 100,000. So you see that the fair value 80 and the carrying value is more than the fair value. So you should recognize a deficit of 20,000, and this deficit should go into SOPL. Okay, so we need to write this in terms of accounting treatment. So we start with the amortization, because you amortize, it's just like depreciation, so you amortize the customer list every year. So your answer will be, right, the first sentence, the customer list, okay, is amortized in 2018 at RM 50,000. Okay, 50,000, that is 250,000 divided by 5 years. Okay, next you will talk about comparison here. So the fair value of RM 80,000 is compared with the carrying value of 100,000. Okay, 100,000. Okay, all right. So since you don't have to mention this pun tak apa. Okay, you don't have to mention that carrying value is more. You just simply say the deficit of RM 20,000 is expense of into SOPL. Okay. Okay, this one maybe you can add in on 31st December 18 the fair value of 80,000. Okay, so that shall answer the question for part B1. Okay, this is done. Show the journal entry to record the transaction for the year ended 31st December 18. So you have to show the journal entry for amortization as well as the deficit. Okay, so part 2, the journal entries. So the first one is on amortization. So we'll debit SOPL and you credit the accumulated amortization by 50,000. Yeah. Okay, second is to recognize the deficit. So deficit, it goes into SOPL and you will credit the the intangible asset. Deficit is 20,000 because deficit will reduce the value of the asset. So you credit the intangible asset. The third one, remember, like I always remind in PPE, every time when you do the revaluation, there are two things that you need to do. One is to recognize the surplus or deficit. Second is to eliminate the accumulated depreciation. That is for PPE. So same goes in IA. You also need to eliminate the accumulated amortization. Okay, in this case it is amortization. So when you eliminate, so you debit the accumulated amortization and you credit the intangible asset. So the accumulated amortization that you calculated is 150,000. So you debit and credit 150,000. So that shall answer question number part 2 here. Okay, C. On 1st January 18, Aman acquired a franchise. Okay, this happened on 1st January 18, the acquired franchise. Okay, remember for IA, only IA that is acquired externally can be recognized under MFRS 138. If the IA is internally generated, it cannot be recognized as an IA under MFRS 138. So this is acquired at 5.5 million. It has a legal life of 4 years, so 4 years, and renewable at the end of every 4 years. The company intends to renew it indefinitely. Okay, so therefore we will not amortize because this is indefinite life. Okay, so we don't amortize for indefinite life. The fair value less cost to sell. Okay, the fair value of the last on 31st December 18. Fair value cost to sell was 4.8 million. Explain the accounting treatment for the franchise for the year ended 31st December 18. So you have to explain everything that happened throughout this year. Okay, when you see fair value cost to sell, we know that this is actually an impairment test. Okay, you will conduct an impairment test on this date. Okay, so normally impairment test is where you need to find the RA, and RA is the higher of fair value less cost to sell and value in use. But for this question, the value in use is not given, therefore this fair value cost to sell is considered as RA. Okay, alright. So now when it is infinite, then you don't have to amortize. So when you do the impairment test, you need to compare RA with CV. Okay, so in this case, RA is 4.8 million. So what is CV? Because it is not amortized, therefore you just carry this as the carrying value, 5.5 million. Okay, so the difference is 700,000. So you see that the carrying value is more than RA, therefore this is an impairment loss. Okay, so to answer the question, state the accounting treatment. So firstly, you would say here on 1st January 18, okay, the externally acquired franchise is recognized as an intangible asset, okay, at a cost of RM 5.5 million. Okay, right, next, since the company intends to renew indefinitely, okay, the IA is not amortized. Okay, make it simple. The IA is not amortized. Okay, but okay, however, the IA need to be tested for impairment at the end of test for impairment annually. Okay, every year you need to test, or whenever there is an indication, of impairment. Okay, so either one. Okay, still remember your impairment when you did the PPE, just similar to IA, you need to perform the impairment test. Because for the IA with indefinite life, you do not amortize, therefore the value of the IA remain the same every year. So we cannot let that happen. If you don't review, we're afraid that the IA will be overstated. So what we do, because you don't reduce the value of IA by way of amortization, so you need to check at the end, you need to test the impairment. Okay, if there is an indication, you need to test the impairment, or if it is annually. All right, for intangible asset, remember, if it is whether it has a finite life or indefinite life. So if it has a finite life, then you amortize. When you amortize, the value of IA will reduce every year. Okay. However, if indefinite life, you do not amortize. Therefore, the value maintain the same. So to avoid overstate the intangible asset, therefore we need to test for impairment every impairment every year. Okay, test for impairment every year, annually, or when there is indication of impairment. But for IA which has finite life, just like PPE, you only test when there is Impairment test is carried out only when there is indication. Impairment test carried out only when there is indication of impairment. So that's the difference. Okay. So I hope you still remember what are the indication of impairment, the internally and the external information will provide that indication. Okay. Is it done? Okay, not yet. Okay, now we talk about on 31st December 18. Okay, so let's continue. On 31st December 18, okay, the fair value cost to sell of RM 4.8 million, okay, is compared with the carrying value of RM 5.5 million. Okay, so since the carrying value is higher than the fair value cost to sell, ataupun yang you don't have to mention this. Okay, since the carrying value is higher, then the difference of RM 700,000 is charged into as impairment loss in the SOPL. Okay. Alright, so that's answer for part C. So that's all. Thank you.